your mic unless you are asked to, just so that we have a very calm environment and nobody's speaking over anybody. If you want to ask a question, you can please put it in the chat box, or you can raise your hand and somebody would call on you to speak. Also, if you have not sent us a message, or if you have not, actually, I'll get back to that. Apologies. Okay, so today we have with us Ephraim Usula. He's an investment professional, and he has experience in private equity, hedge funds, and corporate debt, also financial modeling, asset valuation, negotiation, and structuring. I'm sure that we're going to be very excited to hear what he has to say. And as usual, I hope we all have our writing materials and we're taking notes so that we can get the best of this session. And this masterclass is brought to you by the YCP St. Philip and James Resource Center, which is a project of the YCP. It's a method, or it's an idea that we have come up with to help not only Catholics and Christians and YCP members, but also members of the general public and the society to upskill, so that we can also move with the changing times, as we're aware things are very different from how they used to be 2-3 years ago. So it's our goal to help as many people as we can get new skills, get better at the skills they already have, so that going forward, changing jobs or just having a hobby would be stress-free for them. Okay, so I'm going to hand it over to EJ to start the class, and I hope we all pay attention and learn a few things. Thank you.
Thanks for the introduction, Nonso. Good evening, everyone. Very, very happy to be here hosting this session of the masterclass series. I think as the title implies, we are going to be talking through SME fundraising, specifically what's needed to build a convincing pitch, right? A compelling pitch. So a document, or basically how to sell yourself and your business to potential backers. We're going to be looking through, the different elements that make a pitch compelling. Talking through some of the different funding options available to SMEs globally, but more specifically for SMEs in this particular market. And we're going to go into each of the requirements in a bit more detail. And yeah, hopefully you can get a lot out of the session. Please feel free to ask me questions as we go along, or at the end, whichever one you prefer. And reach out to me if there's any other information you might need, or if anything is unclear. So with that being said, I'm going to share my screen and walk through a document that I quickly threw together. Can everyone see my screen?
Yeah.
Awesome. Okay. So what are the talking points that need to be included in a successful pitch, right? So there are three main things that need to be embedded to compress them into the second point. So it's actually three. The first is to start with a compelling narrative that tells the story of the business and the problem you're trying to solve. Because as we know, whether you make clothes, or you make confectionaries, or sell paint or whatever, at the crux of it, you're trying to solve a problem for a potential customer who is willing to pay for that solution, right? So the general idea is that you have to have a story that's compelling enough to get a third party to back that vision, to invest in your vision, right? The second point is to keep your pitch focused. So what that means is avoiding going off tangent and sticking to a set criteria, just making sure you tick the right boxes so that you save your time as well as the time of the people that you're pitching to, focusing on the key value proposition that your business offers and some select key metrics. We'll get into all this in a bit more detail. And the last one is making use of visuals and graphics to bring your pitch to life, so to avoid reader fatigue. Because when people have to look through documents, they don't want to spend too much time looking through blocks of text. Right? It's good to have charts, graphics, things that basically bring the pitch to life. So yeah, we're going to go into all this in a little bit more detail. But first, a little bit about my background. As Nonso said, I am an investment professional, specifically in the field of private equity. What that means is we raise money from institutional investors like insurance companies and pension funds and sovereign funds and the likes, and invest them into private businesses. Private businesses that are not really startups, but more established private companies like your MZOs, like your MZOs, basically things like that, large private businesses that are not listed on a stock exchange. I've had experience mostly on this side of the fence, so on the investment side, though I've done some advisory stuff in the past. This is just an example of some of the fundraising efforts that I've been involved in. In total, it's come to about $200 in the last 7 years, mostly on the buy side. So yeah, just diving right in terms of the sources of funding available to SMEs. There are three broad categories. There are equity, debt, and grants. In terms of equity, you can see that the requirements. Actually, let me dial back a bit. For equity, what that means is an investor, a third party, is investing to purchase shares in your business, so they become a part owner alongside you in your business. What these providers require in exchange for that money is that your business generates high returns on capital. So they expect to receive periodic dividends as well as an attractive return once they exit. Exit meaning when they sell their shares to a third party or back to you as the entrepreneur. It really depends. But the point is, for equity providers, what they require is a business that needs to be highly scalable. So it needs to be able to grow very, very quickly, or should have a clear path to profitability if it's not already profitable. And the thing is, most equity providers are suitable for companies across the chain. It could be startups, it could be companies in the growth stage, and it could be mature companies, right? Mature businesses. This type of funding is typically provided by what's called accelerators, which are like talent hubs that sort of help bring an idea to life. You also have angel investors, which are typically high net worth individuals or just individuals that want to invest in projects that they believe in. You then have venture capital funds, which are a little bit, well, not a little bit, they are more institutional in nature. So you would not be dealing with individuals, more of an institution, similar to private equity and development financial institutions. So in summary, like I said, equity is mostly capital in exchange for shares in your business, shares that eventually looking to sell either back to you or to another third party. And the key requirements for equity investors is a high return on capital, either in the form of dividends or in the form of a more valuable business that when they sell their piece, they get a bigger sum than they put in. So the next category is debt, which is probably the most common in this market, which is an interest-bearing facility. So slightly different from equity. They are less fixated on higher interested in cash generation. Having a page
Hi everyone, good evening again. Yeah, just give us a minute. He's currently in transit and trying to reconnect. So just give us a minute and he should be back in a second.
Hello? Apologies, I got disconnected.
Welcome back.
Thank you. Sorry, who's the host? I need to be allowed to share my screen. It seems the host has disabled screen sharing. Thank you. Okay, sorry. So I think I'll take. I just want to check. Were you able to hear me on the equity side, or should I just repeat that?
Yeah, that's where we lost you. So yeah.
Okay. So basically, in conclusion, I was saying equity investors, in exchange for the capital that they will be providing, they require shares in your company, and their criteria is mostly that the business have a high return on capital potential. So they expect to receive that high return either in the form of periodic dividends or upon an exit when they sell those shares back to you or to a third party. So the priority for them is that the business needs to be scalable, meaning it needs to be able to grow very quickly and should have a clear path to profitability, right? If not already profitable. And I was saying that some type of equity providers that you can find are accelerators, which are talent hubs that help foster ideas and innovation. You have angel investors, which are high net worth individuals who want to invest behind projects that are particularly dear to them. You have institutional investors such as venture capital funds and private equity funds and development financial institutions as well. Then on the debt side, we have debt is basically an interest-bearing facility, and debt capital providers, are less concerned about high returns on capital and are more concerned about, free cash flow generation. So can the business generate enough cash to service the debt? Does it have a fixed asset base that can serve as collateral? And is the business creditworthy, right? So for this category of capital provider, they care more about free cash flow generation for debt repayment. And this is typically provided by banks, debt funds, microfinance institutions, and the emerging mobile lending platforms. And then the last source of funding for SMEs are grants, right? Which is funding that's provided without the expectation of a return, like you have in equity, or repayments, like you have debt. And grant providers typically, the business typically needs to meet some specific requirements. So, for example, I think the Tony Elumelu Foundation gives out some grants, and I'm not sure what the criteria are. I think the only criteria is that the recipients have to be from an African country and within a particular age bracket. I think that's it. I think Folorisho Alakija also has one, but I don't remember how it's called. But she does this, I think has it specifically tailored towards women. So female-led businesses, that's her criteria. But those are just some examples of the type of grants that are available in the market. I'm sure if you do a Google search, you can find more. But it's basically, it has to fit a particular requirements that is in line with the ideals of the institution that's providing that grant. And these are typically provided by charitable foundations, public bodies, or businesses as part of their corporate social responsibility commitments. So yeah, just to check if you can still hear me.
Loud and clear.
Awesome, thank you. Okay, so delving into the first point, right now that we've gone through the sources of the different sources of funding from SMEs, it's helpful to mention that what we'll be focusing on for this presentation is, it can fit across all three, but it's mostly going to be relevant for the equity and grant sources, right? Again, it can fit for any of the three. So in terms of developing your narrative, the idea is that your business has to solve a problem, even if it doesn't have to be like a pain point, but at least it improves the customer experience, right? I know a lady who makes she sews clothes for nurses and doctors here in Lagos, and the idea is that most of these doctors and nurses, part of what gives them confidence to be able to do their job well is the clothes they wear, how they fit, what materials they are made of, and the general style. And she noticed that in speaking to them, one of the things that was preventing them from being able to do their stuff optimally was the style of their clothing and fit. So she identified that problem, created clothes that were able to meet specification of the doctors and nurses, and that improved their confidence, improved their comfort, and enabled them to dispense their duties more effectively. So, point being, identifying your customer's problem and putting a solution forth for that. And this example I've put here is of a company that's based in the US. They're basically trying to bridge the gap between the minority communities, so like the Black communities, the Hispanic communities in the US, with the financial system. Because there's such a deep distrust, having the global financial crisis and all that jazz, most minorities do not trust the established financial system in the US. So this company, identifying that problem, seeks to create a solution by being the digital matchmaker between those financial institutions and the underserved communities. So this is just an example to give you an idea of how to frame your story, your narrative, just so that it's clear that, regardless of what you're doing, there's somebody out there who's willing to pay for it because it solves a problem they have, or it fulfills a need that they've not been able to fulfill elsewhere. The next point is probably the most important. It's about, having an established structure for your pitch. Structure being, so there are a few things that you absolutely have to touch on. The first is the clarity of, making it clear the kind of products and services you're offering and what your business model is. Business model being, how exactly is this business going to be able to generate earnings? Right? How does it make money? who are your customers, who are your suppliers, your partners. All that needs to be clear in pitch, because that basically gives the investor an idea that you know your market, you know your business, and you know how you're going to generate revenues to be able to keep the business going. And this is a point that's relevant across all stages of your business, whether it's at the early stage or the growth stage or the mature stage. It's important that you have that there in your pitch, clarity on your products, services, business model, your customers, suppliers, and partners, etc. The next is traction. So this is more important for early stage businesses. Maybe you opened up a shop in January, and by September you're trying to raise some money. So the person who is investing would like to know, okay, between January and September, what have you been able to do? What has your traction been like? How many customers have you been able to add? Have your margins improved? What sort of operational metrics do you track? If you're a manufacturer, it would be something like manufacturing capacity utilization. So maybe when you started, you were utilizing 40% of your capacity, and now you're utilizing 60%. Right? That's a good thing, because it means you are sweating your fixed assets a bit more. You are using up your manufacturing capacity a bit more, meaning you're producing more. It's a good thing. So operational metrics like that to show that you're making progress. That's also important, but also for the very early stage, because most people, especially in today's environment, are more inclined to invest behind an entrepreneur who has already got the ball rolling, right, as opposed to funding an idea. There are people that still fund ideas, but the preference, more capital is going to go towards those who have already started in some way. They might not, it doesn't have to be like a fully fledged operation, but at least the ball is rolling. Right? The third point is on the competitive landscape. It's important for the entrepreneur to be able to identify who their competitors are and what makes them unique. So if you're a baker, it could be that your products are cheaper because you're able to get your ingredients at a cheaper rate, right? So you pass on those cost savings to your customers. It could be that you have an innovative way of baking, right? You have some technology that allows you to bake more for less, and you can again pass on that efficiency to the end consumer. Or it could be that you make products that are very difficult to replace or to switch, similar to Apple. Like once you buy an Apple phone, an Apple Watch, an Apple laptop, an Apple earpiece, it's very hard to switch because now all your devices are interconnected. The fourth bucket is like an overview of your macro environment. So understanding, so making it clear to the investor that you understand what's going on in your market. So that would be things like, okay, the growth rate of your particular industry in Nigeria. Let's say if you are doing fintech, if you're doing a fintech project, you're able to talk about the growth of payments in Nigeria, the growth of banking penetration, and all that stuff. That's not very important, especially if you are raising money from somebody who is already here. Chances are they already understand this environment, so you don't really need to spend too much time talking about it. So it's not a very important requirement. Hence why I've flagged it as mid rather than high. The fifth bucket is on risks. So this is very important because it helps the investor know that you are looking at things holistically, not just in terms of things that are working well, but also things that are challenges and how you can overcome those challenges. So talking about the risks, the probability of materialization, and how they could be mitigated. So to give you an example, to go back to the baking example, if I make cakes and stuff, right, and a lot of the flour and stuff I use is imported, chances are, as the naira begins to depreciate because of the effects on availability, the prices for those things that I have to import are going to go up, and that's going to affect my margin. So that's a risk. One way I can mitigate that risk is to look for locally sourced inputs. So rather than looking at imported flour, I can use locally made flour, I can use locally made ingredients to the best, as many as I can find, right? And so the risk there is FX depreciation affecting the margins in your business, and the mitigation measure is finding locally sourced alternatives to to your import-dependent products. That way you can mitigate that risk, right? So having a clear idea of the risks in your business and how they could be mitigated is also very important. It shows the investor that you are thinking through everything holistically. This is the next point is probably the most important bit, which is the team, because at the end of the day, the thing that investors are backing is the idea, but it's also you as the entrepreneur, as the founding team, and that's the most important piece of the puzzle. They want to know about the CEO, the CEO's background, your management team, the strength of your management team, your staff, any of those things, just to make a sense of, okay, can these people absorb this capital I'm injecting, and do they have a clear idea of what to do? Not that you give them money and then they're just scrambling. Then the other point is the funding need. So it needs to be very clear what you want to use the funds to do, be it to purchase raw materials, buy new equipment, hire a more efficient team, acquire a competitor. It could be a myriad of reasons why you need funding, but that needs to be clear, the pitch. The other point is your expansion plan. So if you serve a particular market, let's say you serve the Lekki axis and you want to expand, or let's say you serve Lagos and now you want to expand to the east, right? That could be something that you need capital to do, to set up your bakery, your ovens, and all that good stuff in the east, and you need capital to do that. You have to make that very clear in terms of, okay, here's what I want to expand into, and here's what each naira will go into fulfilling that expansion. It's also important to highlight the expected impact. What I mean by that is, with the money that they're giving you, you then intend to expand your reach, expand your customer base, which is obviously going to lead into higher revenue and higher earnings, right? So clear to indicate that. The other one is financial projections. That's not really important for the very, very early stage. It's only important if you're at the growth stage or the mature stage. At the very, very early stage, like maybe you don't have a business yet, but you have an idea, you don't really need to put together financial projections, because it's almost like an Excel exercise at that point. Same thing with pricing and valuation. That's more for when you're at a mature stage and you have an idea of the value of your business. So what that means is you're communicating to an investor upfront. Look, for this 1 million naira you're giving me, here is the shareholding you would have, right? Whether it's 10%, 5%, whatever it is, depending on your valuation, right? That's more for the middle to mature stage. Same thing with the last one, the capitalization table and shareholding structure. That's just indicating the current shareholders you have in your business. If it's just you, maybe a few friends, or if you already have an existing investor, or like, again, this is more for businesses that are in the middle or at the mature stage. So it's not really important. So in summary, the main things that you need to have, regardless of your stage, is clarity on your products and services, your business model, understanding of your competitive landscape, traction, so how much progress you've made since you started, the risks, how you're going to mitigate those risks, the team, the strength of the team, the previous experience of the team, and what each member of the team contributes into making the business a success. And then your expansion plans. So what you intend to do with the money, basically, not just expansion, it could be setting up, or anything. Basically, just a clear understanding of what you want to do with every naira you're asking for. Those are the priority things. Everything else is a nice to have, but not very, very important. So the last bucket is the structure. Right. So not the structure, the aesthetics. So using visual and graphics to bring the pitch to life. As you know, most people, like, if you send someone a document and all it has is just words and text, chances are they're going to get bored of reading it very, very quickly. So one way you can overcome that and make your deck attractive for people to look at is to include a lot of graphics. As you can see, this is a snapshot from Lapo, which is a microfinance bank, which I think most people will be familiar with, the largest in the market. And as you can see in this deck, we made it. There's some nice graphs, a picture, and some context on the background, right? So just a way to give some people something visually appealing to look at, and it's easier to get your point across rather than having just a block of text that people have to read through and probably stop reading by the time they reach the fourth paragraph. So very, very important. Utilize charts, pictures, graphs as much as possible, icons, any type of graphics, basically, just to bring it to life. So yeah, so that's everything. In terms of final thoughts and in conclusion, just to remind you that the pitch deck is literally just the start of the process. So it's just a way to get people interested in your idea, in your vision, and get them behind it. So it's important to be able to set the stage for a deeper conversation with your deck. Aside from this, at the next stage, you probably need to tailor your deck, your pitch deck, to fit any particular investor you're talking to, because it's not a one-size-fits-all situation. There are some investors that focus on some specific sectors. So if you were doing something banking or financial services related, there are some specific type of investors that go after projects like that. So you have to tailor your deck towards that kind of investor. It's also important to utilize storytelling, like I said, to make it clear the issue you're trying to solve and why you are the best or one of the best options in the market to solve it. Having those things in place should set you up for long-term success. So happy to take any questions. If you want me to go through anything again or shed further light, I'll be happy to do that. Thank you.
Thank you. Thank you very much. Since I was thinking the moderator was going to address before questions, but let me ask my question if that's allowed at this time. Okay, so
yes, you can go ahead.
Okay, good. Thank you. So first off, thank you very much for the insightful and apt delivery. And I wanted to see if you could shed more light. Like you clearly during your closing, the closing section stated that you have to tailor to your audience. For instance, you mentioned if it was in banking or can you? So I would like to ask to try and connect it to my industry. Well, the industry I practice privately apart from my other industry is tech. Okay, so it's a tough one, it being that tech is the tech solution can cut across diverse a diverse, profile of
Correct.
customers, so to speak.
Yeah.
And it's quite tough sometimes when you are presenting to just a set of people who are not really in touch with that, demography. So let me give an example. Some years back, I tried to start up a business, and the business was was structured in a manner that I was going to be delivering this presentation to a group of men with just one woman on that board. And this presentation was for a tech product that is targeted mostly to youthful age women, so young ladies, if I can say. And the woman on the board was quite advanced. Okay, so what do you think in this case and in the other umbrella case which I mentioned, when you have your products across all demographics, but you're presenting to a streamlined board? What do you think one should apply? Are there techniques one can use to, get the favor of this audience? Hello, am I still audible? Or
Yes, we can hear you.
okay, so we just can't hear the presenter at this time. Sheesh, okay, we lost him again.
Maybe he didn't hear you, or is he still around? Is he within the group?
Yeah, so he's trying to reconnect. But if it's possible, can you put your question in the chat box as well so that he can read it? But also, when he's back, you'd have another chance to explain it to him.
The host and the co-host can also keep the house lively while we wait for him to reconnect.
Okay, that's fine. Okay, so I'm sure we're all learning a lot, and from the look of things, we're fully engaged. Um, other than Jackson, does anybody else have a question so that we can just take down all the people that have questions? You can unmute your mic at this point if you have a question or want to ask a question later on. If not, this slide is going to be sent to us. So if you've registered via the registration link, a copy of the slide will be sent to you. And if not, please indicate so that we can also send it to you personally as well, so that we can have that for future reference. Just a quick announcement. We shall be having our Lenten retreat on Saturday, starting at 7 a.m. with Mass. So I would hope that I would see all of us so that we can finish the Lenten season with God. Yeah. Okay. So while we wait for AJ, Emmanuel, do you want to say something as well? Do you want to let us any information you have for us?
why we await for professionals. Professionals, good evening all. While we wait for EJ, I also want to encourage each and every one of us to reach out to our members, especially within this period. People who, in
Hello?
one word or the other.
Hello?
Yeah, we can hear
Yes,
you.
we can hear you, EJ.
So sorry, I'm having severe network challenges. So I just joined with my phone, so I'm not able to share my screen anymore. But someone asked me a question. I didn't get a chance to see the name because of the screen sharing. But if the person is still on, I'm happy to answer your question now.
Okay, I'm still here.
Okay, awesome. Okay, Jackson. So I was saying, in that type of situation, you can't really. So when I said tailor your pitch, it was more if you have like if you're sector specific, you can still target sector specific funds or sector specific experts, but the first step would be to approach generalists, right? So people who just have capital to deploy. It doesn't really matter what sector, right? And most angels, funds, banks are generalists. They don't really focus on a sector. But um, in that example, the best thing you can do is try and demonstrate, the viability of the product or the software that you were pitching, so they are able to understand. Maybe if it's something where you already have a demo that they can use and see for themselves, then that could strengthen your case, right? That's how you can make them believers, so to speak. Or you could get a referral from someone who has used, so someone who might have tested your product or service or used it in the past, to go ahead and give a reference on your behalf and say, look, I've used this thing that Jackson has developed. The technology is solid. It does what I need it to do, and I'm a happy customer, right? So that way they're able to see that, okay, you know what, even if they have not used it themselves, there's proof of concept, so to say. But yeah, the idea is to get them to buy what you're selling, right? To believe in what you're selling. And the way you can do that is either get them to use it themselves, maybe a demo, or get somebody who has used it to share their insights with them. Hopefully it's a positive experience they had. But yeah, maybe to help me answer the question better, would you be able to give some detail into what the product was and what the difficulty in converting those people you were speaking to was? Was it that they didn't believe in it, or like what other context can you share?
Okay, let me try and give specifics. So it was mostly targeted as at the females. Okay, it's a software that the females will use for so and so.
Okay.
Okay, and this it was a tough crowd because these were a panel of males,
I see.
and despite, so the one thing with having these softwares is when you can demo a fantastic product, which was done, okay, because this demo was done. You can't go without the product, okay, and then you can show statistics on. Of course, you have to go before you get your product out there ready to start seeking funds. You would have conducted, apart from the technical testing from the alpha, beta, and whatever stages, you then have the product we do a soft release, okay?
Yeah.
And a selected few individuals of the target market will access the product and give reviews.
Yeah.
This is done. Okay. I'm bringing this out because it seems to me like it's a Nigerian thing. We were trying to convince these people on the idea that because it's built not just on the product, but on the idea that these people will buy this because they are doing this manually currently, and they are facing these challenges. Okay, but it was the male dominated crowd. So this is the point I'm trying to bring out. So how do we now tell, because these people were the people that were willing to listen to our pitch in the first place, but they are males. And when we tried to go to them, it was just one female, and she was the only one who can see from the eyes of the female. But she, being like one out of the 8 people that were seated that day, cannot take the whole decision. Okay, so yeah, that's what I wanted to get from you. Like, how do we approach this tough crowd then?
Yeah. Okay. Yeah. I see. So yeah, it will have to be. I mean, the one option would be to approach a different crowd, maybe a female dominant crowd, since they will probably understand the utility. But that doesn't mean you cannot still try and sell the idea to a male dominated crowd. The important thing is that male crowd needs to see that, look, this product is something that women will buy given the opportunity, like it's useful to them. So there's a captive market for it, right? At the end of the day, these people are hoping to get behind your idea in order to achieve a return. And what you're trying to show them is that, look, this is something that the women want, this is something that they like, and this is something that they're willing to pay for. So far as they understand that and you're able to really drive that point home, maybe you can show them, oh, look, this is the size of. So if I were to throw an example out there, let's say you were doing some new type of menstrual pads or something. You say, look, here's the number of women in Lagos that use pads. Let's assume there are 14 million. I don't know the number, but I'm just assuming. That's a 14 million person customer base right there that you can sell to today, right? If your product is truly is more efficient and it works, right? That's a market you can sell to today. So that should give, whether it's a male or female audience, they get a sense of, oh, this is a big market, right? It's something that could be easily penetrated, and you have the product to do so. So I guess the answer would be understanding, like making that point very clear that, look, this is a winning strategy. Here's why. There's this number of people that spend this amount every month on menstrual pads or whatever it is that you are providing, and you are saying we can come into this market today and capture that spend, or at least a portion of it, right? So I mean, so in summary, my 2 recommendations would be either target a more female dominant board, or if you find yourself talking to mostly men, selling them on the commercial opportunity, right? Regardless of whether they understand the application or not, everybody understands where there's money to be made. So if you can make that point very clear that there's an opportunity to make money, but then also there's an opportunity to achieve positive impact. Maybe your solution is a cleaner, more efficient way of doing a specific thing that women normally do, then that could also help, if that makes sense.
Yes, it does. Thank you very much. So I think I'll just focus on telling them this is the commercials, not the core idea. Thank you very much.
Yeah. Does anyone have any other questions? Maybe on the slides. Let me see. Can I share slides with my phone? Let me try. Any other questions, comments?
I have a question.
Sure.
Hi. So my question is, how do you value your business? How do you know what value to place on your business? And at what stage do you know how much your business is worth?
That is a very good question, and that can be a masterclass all on its own. But I'll give you some context, right? So there are two ways that you can, or actually there are multiple ways you can value a business, but there's mostly two common ways, right? One can be what is called intrinsic value, which is the value of the expected cash flow that business is going to generate over its lifetime. So what you are doing in that case is you are discounting the projected earnings that business will make over its lifetime to today, right? And then using that to determine how much it's worth. Because at the end of the day, most businesses are for profit, meaning they are there to make money. So the value you will place on it is the amount of money you expect it to generate over a period of time, discounted back to today. That's the purest way. Another way you can do it is a multiple on an operating metric. So a multiple being that's more of a comparables approach, where you look at similar businesses that have similar size, similar profiles, and then you take their multiples. These are businesses that are listed. So let's say for example, I do construction, right? I make building materials or something, and I'm private, but there's a publicly listed company that does something I'm doing. So I would look at the multiples for that publicly listed company, like multiples of revenue or EBITDA, and then apply that multiple to my own business, right? What that means is, if that listed businesses have their information publicly because they're listed on a public exchange, right, for people to buy and sell their shares. So if that business is very similar to mine, I'll simply take the multiples that they're using and apply it to my own business, right? So if it's a multiple of revenue, that would be, let's say, if that business that is listed has its valuation is 1.2 times revenue, that means my valuation can also be 1.2 times revenue. Maybe if my revenue is let's say 2 million, 1.2 on 2 million is what? That's 2.4 million. That means my business is worth 2.4 million, right? That's basically how you go about it. Is it going to be a blend of those two? Either discounting the expected cash flows to today, or a multiple of your operating metric, basically.
What if a follow-up question. What if your business is a new business that you can't find anybody that has done it before, there's no listing anywhere, and you can't project what it could be worth or how much it could make over a period of time? What do you do?
That's also a very good question. So what most people in that situation do is they value the business at cost. At cost being how much have you spent since you started in getting this business off the ground? If I've spent $5,000 getting software, renting a place, hiring people, then that $5,000 is the value of my business, because that's my cost so far. Right. That's one way to do it. A more common but complex way to do it is to value it based on your last funding round. So because you are just starting up front, you've not had any funding round. What some people do in that case is they issue what is called a SAFE, which is a simple agreement for future equity. I don't want to get too technical here, but point is, you are basically collecting money today for a valuation in the future. So you're telling them, look, this money you're giving me today, the valuation that you are putting this money at will be reflected at some date in the future, basically, right?
Right.
So it's going to be one of those two. Either you value it at cost, or you value it at you don't value it. You collect money today, and then the valuation will be determined in the future.
Right. Do you think that investors will be open to take that risk?
Of course, and again, that's a good question, because the kicker with those safes is that in that future valuation, whoever gave you that money initially would enter at a cheaper rate than anybody that's coming in new would. Let me put that into context. If I'm giving you money today with a safe instrument, what that means is, okay, let's say I'm giving you that money, I'm giving you 1 million naira, and I'm saying, okay, in the future, when you are going to raise more money, whatever valuation you are going to be at that future, because I've given you money today, I'm going to enter that round at a, let's say, 10% discount or 50% discount, however big the discount is. What that means is, if your valuation in that future, let's say that future, your valuation is 2 million, everybody else is investing in you at that 2 million valuation. Because I invested in you when you didn't have anything, instead of me entering at that 2 million, even though your business is valued at 2 million, I'm entering at 1 million, which is a 50% discount. So that gives me compensation for the risk. What that means is, I'm entering your cap table at a lower cost than other people, at a 50% discount to other people. If that makes sense. I can send some resources on safe agreements and how they work on the chat, but basically it's a promise for future equity. And in that future, because I've given you money today, I get to enter that your new round at a significantly lower valuation than everybody else. That's how you compensate me for the risk, by giving me more equity at a cheaper rate later down the line.
Okay, that makes sense. But the thing is, I'm in a process of trying to evaluate my business, right? So I don't know if there's more documents that you think are too complex to discuss here. I don't mind you sending them to me later. I honestly would appreciate every help I can get.
No, sure. We can have a conversation about that on the side. If it's a business that already has operations, then you can probably use a multiple. The thing with safes is it's mostly for, anyway. No, we can talk about that. We can talk about that offline. Just shoot me a message. I can share some stuff on the chat, but specifically for what you're trying to do, if you can share some more context, I might be able to help you put something together. It shouldn't be a problem.
Okay, I'll send you a message later after this. Thank you so much.
Cool, no worries.
Yeah.
Does anyone have any other questions, thoughts? If none, thank you for taking the time. I will share the slides on the group chat, so you can look at any point in time, pick some pointers, and feel free to shoot me a message if you have any follow-up questions or any thoughts or anything that you would like to share. Thank you all for taking the time.
Thank you.
Thank you very
Okay,
much.
thank you, Ephraim, for this very interesting topic. I'm sure we've all learned a thing or two. And as I said earlier, we're going to be sharing the slides with us so that we can have some resources to work with. And just on the side, as usual, if you have a topic or you have a particular interest that you would like us to cover in the resource center, just send Kingsley or me a message and we'll include it into the schedule. Once again, thank you very much, Ephraim. This was very interesting, and I'm sure we're all well eager to start. I feel like now is the time to start a business with all this information I've learned. So yes. And you can also reach out to him. If you don't mind, EJ, would you be able to drop your LinkedIn so that people can reach out to you as well?
Sure, I'll put my details in the chat. I think everybody has it. Everybody here is on the group chat, right? So you should have my number.
you can also send it to me, and we'll be able to share it with those who are in the group chat as well.
Sure.
All right. Thank you very much for attending, everybody. And we hope to see you in the next class we're having next week. We're hoping that it's going to be as interesting as this one. And as usual, thank you for your patience and thank you for your participation. Good night, everybody.
Good night. Thanks, everyone.
Thank you. Good night.
Good night. Appreciate this.
Thank you. Have a good night.
Once more. This is room temperature water. Yeah, normal water. Come on, milk, I'm really able. As I asked you. Didn't we depend on the milk?